And these large companies are spending the money. Who supplies them?
Hi, good morning, viewers, and welcome to episode 5, season 3 of Unscripted. Super delighted to have our chief economist for Prudential and for Eastspring Investments, Ray Farris, with us this morning. Good morning, Ray.
Thanks for having me, Salman.
Thanks for being on the show. Good morning. So we're gonna take a view on a mid-year outlook. We're gonna hear what's on Ray's mind, right across the board, from global rates to the dollar to Asia and beyond. I'm sure you're going to find it a fascinating episode. So Ray, let's dive into it. Your thoughts first, just on global interest rates, what your perspectives are, U.S. rates, and then the impact on Asian rates by central banks because of energy prices. Would love to kind of hear your thoughts on that as we kick off.
Sure. One of the key things that investors need to keep in mind is we've entered into a global monetary tightening cycle that's being led by Asian central banks and the ECB in response to the Iran war, the energy shock. But there's too much inflation in the US. That's been the case for over 5 years. And the Fed now looks likely to hike rates at least once later this year.
Okay. And bring that to Asian central banks and the actions you are seeing versus kind of how you look at the second half for some of the Asian economies on rates.
Asia is going to have further interest rate hikes. Not every single economy, certainly not China. But the countries that have the weaker currencies, Indonesia, Philippines, are likely to hike rates again. Korea probably will have to hike rates. It's got a bit of a different story, both a currency that's a bit soft, but crucially, a very strong economy because it's so heavily geared into AI. And I think ultimately India will end up hiking rates much later this year because inflation is going to grind higher.
Okay, and we'll come to those economies as well, Ray. Just before we go there, talking a little bit about US dollar, de-dollarization, your thoughts on that journey. I know we called it early, called it right, but what are your thoughts on the US dollar over the next sort of 6-12 months and what you're seeing?
Well, okay, so let's start with de-dollarization. There's no real de-dollarization. There's portfolio diversification that's taking place across some portfolios, and that's something we've argued for 2 years, largely because we've argued that Asia would outperform the US. We did that in 2025. Asia outperformed. We've argued Asia would outperform in 2026. Asia is outperforming in 2026. So that portfolio diversification makes a lot of sense. The Fed's now moving toward interest rate hikes. That's supporting the dollar, giving the dollar new strength, and that is putting pressure on Asian currencies. When you take all of this together, a change in the interest rate outlook, a change in the currency outlook, it means that investors have to be much more discriminating and more thoughtful about where they're going to invest. So Asia is not homogeneous. It's certainly not homogeneous in the way that it's performed so far this year. It's been largely an AI trade. That's going to, I think, morph a little bit into the second half of the year. Japan is now performing very well. Thailand is performing strongly. I think as we get into the second half of the year, we'll start to see, with greater currency stability in India, probably some and lower energy prices, a change in the nature of performance there. It won't necessarily be the best performing aggregate market, but there are opportunities in individual companies for investors who are able to do deep research and find those opportunities, among an otherwise kind of neutral to Midland type of market.
Just touching on that further, you wrote a recent piece you published, which was fairly constructive on Japan.
So, what we argued in Japan is it's outperforming. It's probably going to continue to outperform. Well, that's because it has a meaningful AI exposure. But if you look at earnings revisions in the equity market, it's got some of the strongest upward earnings revisions of any major economy in the world. That's largely IT, but it's also coming in other sectors, in materials, in financials, in a couple other sectors. And it's backed up by an economy that's actually doing very well. So leading indicators point to stronger export growth. the strength of exports and the fact that the yen is now very cheap, so exports are very competitive, is producing a much stronger than expected CapEx cycle. That combination of good exports, strong CapEx, and a government that is shifting fiscal policy to support strategic sectors is helping to keep wage growth supported. So now household incomes are growing about 2% in real terms, and that points to consumption growth. I'm not saying that the Japanese economy is going to boom and turn into the Chinese economy growing 5% a year, but in Japanese terms, this is an economy that's doing pretty well. And all of that supports earnings growth just intrinsically. In the background, corporate reform, so the end of cross shareholdings, reduction in cross shareholdings, better use of cash on balance sheets, M&A, all of that is leading to return on equity going up. So now for 2026, 2027, the consensus expects the highest return on equity in Japan's history.
Thank you for that. Appreciate it. And just segueing from there into China and your thoughts on China.
China's highly bifurcated. We've argued all year that it's really an A-share story, not an H-share story, and that's the way that it's played out. A lot of that is because the focus of policy this year is on strategic sectors, especially industrials. Those are the areas that have so far done best. The government is not subsidizing consumption this year, and consumption is weakened. The latest retail sales numbers are an odd contraction in retail sales on a year-on-year basis. We don't really see that changing much. Policy doesn't look like it's going to shift to some broad stimulus. Policy looks like it's going to continue to focus on strategic sectors, AI, the places where the government believes that it needs to develop over the next 3 to 5 years. That's predominantly an A-share story. And it's not even a broad buy the CSI 300 story. It's specific companies within that. So as an example, clearly China as an economy is going to benefit from a greater post-Iran war demand for electric vehicles, batteries, renewable energy technology. But if you look at some of those companies, despite strong export growth, there's not necessarily a lot of great profitability. So you have to be very careful in just simply trying to buy into a theme. You've got to do the work of trying to figure out which companies actually can make money on that theme.
We saw appetite from allocators both outside of Asia and within Asia as well towards Asian assets, Asian equities. The Iran war came in, energy issues went a bit off risk-off mode. As you think about investors in Asia and allocators outside of Asia investing into Asia, how would you kind of talk about that and bring that risk on, if that's a fair thing to even say? But I just wanted to kind of build that out because we see that on the investor side, this hesitancy a little bit around just sort of demand for Asian assets post the Iran conflict.
I keep coming back to what's actually happened. You've made more money in being invested in Asian assets than you have in U.S. assets. Take the Mag 7. The Mag 7 are down for the year. They're down relative to their October 2025 high. Hasn't been a particularly good performance. Yet Taiwan, Korea, Japan, Thailand, China A shares, all outperforming. So diversification of a portfolio into these areas we think makes sense. It has made sense. It's going to continue. The reason is the AI boom is an infrastructure boom. We can argue about who will ultimately be the main beneficiary. We don't know that, but the key thing is that there is still financing for that, and these large companies are spending the money. Who supplies them? It's companies in Asia that are the suppliers into that boom. So in many respects, Asia is agnostic to which LLM model ultimately proves to be the one, because they all buy from us. We just want the CapEx to continue, and that looks like it's going to happen at least through this year and probably into next year. And that justifies diversification into the region. But there's more than just simply tech. As I noted earlier in Japan, there are upward revisions in sectors outside of tech. Thailand is not really a tech story, but it's performing reasonably well. Some of our active selections in India are outside of the tech sector. And crucially, one of the things that if you talk to, say, John Tsai, our head of growth equities, one thing he'll note to you is that those non-tech names give those portfolios a cushion, a diversification cushion, at times like the last couple of days, when we get very high volatility in markets because of chips selling off and AI names selling off.
Correct.
So doing that homework to find good opportunities away from the biggest theme in the market helps portfolios because it gives diversification.
As we wrap up, always a bottom line, anything that you feel I didn't touch on or you think investors and allocators should be thinking outside of everything we've talked about?
Well, we talked mainly about equities, which are a growth play. There's also income. A lot of clients, a lot of investors need to focus on income, and there are two ways to get it. One is we can actually get it through equities. So if we look at portfolios that are built on not just generating some equity growth upside, but also dividend income, actually a lot of names in the tech sector in Taiwan produce pretty high dividend payout ratios of over 50%. Industrials in China do much the same thing. Names in Singapore outside of tech, so outside of that tech volatility, can generate very high income. The second way to generate income is in Asia fixed income product, which is it outperformed last year. It's outperforming again this year. Now, we've argued against being long duration because we've expected U.S. yields to rise. But if we focus on shorter duration, higher quality, in some cases high yield names, but higher quality. So, 2-year paper in which we can really look at the cash flows and say this company is going to be able to pay us. They're very interesting yields that can be accessed.
Excellent. Thank you. Appreciate that. Ray, always fascinating to hear your thoughts. Very important, hopefully, for our viewers as well as we think about Asia. Thank you so much for taking time out and appreciate you being on the show.
Thanks for having me on.
Thanks, Ray. Appreciate it.